In February of this year, auto loan defaults hit an all-time high at 8.8%. In March of this year, 8.5% of subprime borrowers were defaulting or at risk of defaulting on their auto loans. According to TransUnion, Gen Z and millennials are defaulting on their loans at a significantly higher rate than their pre-pandemic levels. Gen Z's past due rate is 2.21% compared to the pre-pandemic, which is at 1.75%. And millennials are currently at 2.14% compared to 1.66% pre-pandemic. And these figures are expected to continue to climb because of the fact that money is getting more expensive to borrow. Supply chain is still a major issue affecting the auto industry as well as a wide variety of industries as a whole, and inflation is affecting everybody's bottom line. But the real question is, are auto loan delinquencies a concern for the average consumer? What does this mean for both the car market and the economy as a whole? And of course, what does this mean for you if you're somebody who's in the market for either a used or new vehicle? And today we're going to be addressing all of those questions and more. Now, it may or may not come to a surprise, but over the last 2 years, auto loan delinquencies have been at a pretty much all-time low. In fact, this isn't exclusively true to auto loan. Home delinquencies, credit card delinquencies, auto loan delinquencies have all been at historical lows for the last 2 years. As shown here in a graph from the Federal Reserve, delinquencies decreased significantly right at the start of the pandemic and have remained relatively low ever since. And there are a few different reasons for this. Number one, and probably one of the most notable reasons, is of course forbearance with auto loans. You see, during the pandemic, a lot of financial institutions that offered loans for cars offered some sort of forbearance program throughout the pandemic. And what this meant is that some borrowers didn't have to make payments on their car. It basically put a freeze on their monthly payments for a limited time. And even for those people that may not have taken advantage of auto loan forbearance, there are many people that took advantage of mortgage forbearance or student loan forbearance. And all of these forbearances that have been offered throughout the last 2 years have had a trickle-down effect on loans across the board, decreasing the total number of default loans that borrowers have had. And number two is stimulus money. Stimulus money over the last couple of years have really helped Americans get ahead on their bills, pay off some debt, and this, of course, helped delinquencies in the process. But interestingly enough, there is a third reason, and I think that this third reason oftentimes gets forgotten because it's not talked about in mainstream media nearly as often as stimulus money or forbearance. And that is the fact that throughout 2020 and 2021, high-risk borrowers, meaning borrowers with either high debt-to-income ratio or alternatively low credit scores, have not been able to get approved for auto loans at the same rate in which they once were. In fact, according to the Federal Reserve, at the start of the pandemic, loan originations with the lowest credit score borrowers plummeted and have since remained very low. But loan originations with high credit borrowers, meaning low-risk borrowers, plummeted at the beginning of the pandemic, but have since recovered quite a lot. So basically, this is a long-winded way of saying that throughout 2020 and 2021, high-risk, low-credit borrowers weren't oftentimes getting approved for auto loans. But then that, of course, begs the question, why? Why are high-risk borrowers not getting loans at the same rate in which they once were? And according to the same study by the Federal Reserve, though the amount of auto loans that got distributed for high-risk, low-credit score borrowers decreased in 2020 and 2021, the inquiries by these same borrowers actually increased during the same period of time. So high-risk, low-credit score borrowers were in fact applying for auto loans, they just weren't getting approved. And there are a lot of different reasons as to why this could be the case, but one interesting theory was that because of mortgage forbearance and student loan forbearance, it made it harder for creditors to gauge credit worthiness. And because of this, if an auto loan borrower or an auto loan applicant had these types of loans that were currently under forbearance, they would just simply get denied the auto loan because creditworthiness was too hard to determine. Another thing that's interesting to note, especially on the topic of this video, is that 40% of auto loan delinquencies were originated within the last 12 months. This means that 40% of auto loans that are currently in delinquent status are loans that have been taken out within the last year, and the vast majority of these loans came from low credit, high risk borrowers. Low credit borrowers being denied auto loans over the last 2 years. Auto loan purchases being temporarily paused throughout the country in 2020, as well as an influx of cash through the stimulus money program can be accredited for why we've seen a decrease in all-time low delinquency rates whenever it comes to auto loans. And though this explains why people haven't defaulted in the last 2 years, it doesn't explain why we've seen a sudden increase in defaults in the last 4 or 5 months. And the truth is, there are a lot of different reasons. Stimulus money, or lack of stimulus money, is definitely credited for one of the reasons. People had an influx of cash for a year and a half, 2 years' time, and now they no longer have it. And as a result, this is definitely affecting some people's bank accounts. But a bigger factor here, like a much bigger factor, is inflation. Inflation has risen to 8.6%, and this is taking a massive toll on Americans' bank accounts and is a massive factor whenever we talk about auto loan delinquencies. Gas is more expensive, food is more expensive, everything is more expensive than it was last year or 2 years ago. In fact, according to a CNBC article, due to inflation, the average American household is spending an extra $327 per month just to live. And this was taken back in April, so it is almost guaranteed to be higher than that now. The truth is that over the last couple of years, we've seen a perfect storm for people's financial situations. There was forbearance on a wide variety of different loans, it was very cheap to borrow money, and money was flowing through the variety of different stimulus packages that were offered. But things have dramatically shifted over the last 6 months. Stimulus is dry, inflation is high, and over the last 2 years, we've seen the average car loan increase to an astronomical number, which means people are spreading themselves thin in order to buy a new car. And all of this is compounding together to see what we're seeing today, which is an increase in delinquencies. Now, according to economists, the increase in delinquencies could be an indication that a recession is looming, which I think many of us could agree on. But other industry experts, like the Ford Motor Company CFO, states that this is just the market returning to normal, and it isn't a reason for concern. And to be honest, from my perspective, though I'm certainly not an economist or the Ford Motor Company CFO, I don't really think that the increase in auto loan delinquencies is either good or bad. If you're somebody who recently purchased a car and you spread yourself a little bit too thin in order to afford that, then sure, I think that you could possibly be in trouble. But alternatively, if you're somebody who's been sitting on the sidelines for the last 2 years waiting for used cars to finally become affordable again, then this could be the opportunity that you've been waiting for. The increase in delinquencies that we've been seeing could have a trickle-down effect on the used car market and increase the amount of used cars that are available. The increase in interest rates makes it harder and more expensive for people to borrow money, which means they're less likely to buy that new car and finance it. And inflation has made it significantly more expensive for people to live, which means people are significantly less likely to justify that new car purchase. We, of course, haven't seen used car prices go down this year so far, at least not dramatically. But I do think that all of these things that I've discussed in this video could be indicators that the used car market may start declining soon. And though I don't think that this change is going to happen next week or even next month, I do think that these changes that we're seeing in the used car market whenever it comes to auto loans and delinquency rates, I think that there's going to be a trickle-down effect and it's going to cause used car prices to decrease as a whole. And if you're somebody who's been looking to buy a car but you've been waiting for the right time, I think the next 6 to 12 months could be that right time. But with that being said, you guys, I wanted to make this video because I've been seeing a lot of different information out there whenever it comes to auto loan delinquencies. And though there is no dispute, there is no debate that auto loan delinquencies are decreasing, I definitely don't think that it's a cause for concern, especially if you're somebody that has been more fiscally responsible over the last year and a half, 2 years time. But like always, you guys, I hope that you enjoyed this video. If you have any questions, comments, if you have anything to add, make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit that subscribe button, and hit the notification bell. And I will see you guys in the next video.